Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 2nd, 2018. I hope everybody had a great weekend. It's midday, or I'm sorry, heading into the last 2 hours of trading. It's 2 p.m. Eastern Time as I start this video, so I wanted to just do another update on the markets. We're getting some pretty significant technical developments today, so if these stick, it will further add to the longer or intermediate term bearish case in the markets. Quick recap: this is the S&P 500. We're looking at a 10-year weekly chart. When we zoom in, couple weeks back, 2 weeks ago, we made a solid close below that trend line that I'd been highlighting, the primary uptrend line off the early 2016 lows. After that initial correction in January, had a little snapback rally and a stick save. So again, weekly charts, all that matters is a weekly close. Now you can see how well that line has acted as resistance, which is often the case. Support, once broken, becomes resistance. So the following week, the S&P tested it, um, but failed to get back below there. Reverse closed well below it, and now is moving lower. So long term, there's not. I don't see much in this chart that tells me to step in here and buy the dip at this point, especially longer term money. If you're an investor or a trend trader. And now, so what's happened today? QQQ, which has been the stronger index pretty much throughout the entire bull market, and most recently rallying to new highs after that correction in January. As mentioned, that was a divergent high, and it started to play out for an impulsive correction so far. You can see this is a trend line off the mid 2015 lows, which is really the same as the early 2016 lows. NDX, the actual index, didn't have that long wick there, or tail, I should say, that long tail or shadow on the candle. That was just a mini crash in the Qs. But either way, it lines up perfectly, so I just extended that. So if you look at NDX, you're going to see this trend line from this point where the S&P bottomed in early 2016. And I have an alternative trend line. That one's already been given, but this is the one I'm focused on. And you can see that we're now clearly below it. The week has only started, so it's Monday, but with the S&P now 2 weeks into a breakdown and well below its trend line, and the S&P 500 being more indicative of the overall economy, more diversified, it was a matter of time, and now we've had a breakdown in QQQ. The red line is a 40-week moving average or 200-day exponential moving average. A lot of times buyers will step in there and also buy that. But again, the longer term picture is just becoming increasingly bearish. We didn't have a successful defense of this line on the S&P or the Nasdaq 100, and again, we had that divergent high there. So, barring any crazy move this week and a close back above that level, especially if the S&P 500 recovers, we're looking like chances are some more downside. I'll get to the short-term targets in a second, short-term charts, and give you those targets in just a second here. Before we do that, I wanted to just share my trend indicators. I have a lot of different trend indicators I'll use, but this is one layout I have. Looks like I need to fit that chart in there like this. There we go. And there's four trends. I have what I call the daily short-term trend, the daily intermediate-term trend, weekly trend, and monthly trend. In other words, these are both daily charts, these bottom two. This is a weekly chart, and this is a monthly chart. Monthly trend is still well intact right now, as is the weekly trend. The Qs have been just so strong. When you see these green bars here, the trend is bullish. But what we need to point out here is the short-term trend. Up top, there's a couple trend indicators. Number one, if the Qs are trading or the S&P 500 is trading above or below their 20-day exponential moving average, that helps to define the trend. And so you can see here we're clearly trading below it as we broke below it back there. This was the biggest correction during the entire bull market off the 2009 lows, and gave you not the earliest of sell signals because it's a daily trend indicator. Your earliest sell signals will come on the 60-minute charts and the other intraday charts. But you can see it does a pretty good job. And when this histogram goes red, I also have a couple other pairs. They're not up top. 13 and 30, the 39 and 13 EMA pair and the 26 and 13. They're both solidly red right now. It doesn't take a rocket scientist to tell you the near-term trend in the short-term trend is bearish. So now what's more significant, let's go here and look at this, and I'll do this on the S&P 500. Let's expand this window. And what we're looking at is the daily intermediate term trend, and this is simply a 20-day exponential moving average and a 50-day exponential moving average. The 50-day in red, the 20-day in green. So the 20-day is the faster of the two, meaning it will act more rapidly to a change in prices. And this is a fairly accurate trend indicator. When the two cross, when the 20 crosses down below the 50 after the trend has been bullish, that gives you a sell signal. And as you can see here, if I zoom in, you can see as of today, and of course the day's not over, but we have less than 2 hours to go now. We have the first, we call this a death cross. A golden cross is when you have a bullish cross after a bearish trend, right here, for example. And just to clarify, this histogram down below, what I did is I just made a custom histogram up uh, that will show me when the two cross. Right here you had a bullish crossover after a brief whipsaw signal, and for the most part the trend in the Qs has been bullish now for quite some time. So you have very few signals, and those that were whipsaw signals. I often say there's not any perfect indicators or anything perfect in technical analysis or trading. If there was, someone would use it, and it would get out there and we'd all be rich. Some things work for a while, some things work better in other markets, some markets than others. But overall, and I'll show you a longer term track record of this, it does a pretty good job. So if you look at the crosshairs, that's when the lines crossed on the SPY back in October of 2016, right here, and it got you short or out of your longs, and you missed that big swoon down in the market. So it captured the bulk of this trend. And we had a bearish cross or a death cross in the 2050 EMA pair on the daily chart on SPY back here. What was that? March 23rd. So the SPY is clearly, this trend indicator is clearly bearish right now, without any chance of it even flipping close to bullish anytime soon. So right now I'm watching the Qs, see how we finish the day. And again, whipsaw signals are possible. Sometimes you get a day or two below, but for the most part, you can see when this histogram is green, meaning that the 50 or the 20 is above the 50-day, then the trend is bullish, and vice versa. Now here's that same 2050 EMA pair on the S&P 500, but what I did is I went back, this goes back 12 years. It might be a busy chart, but what you want to look at, you can see the vertical lines in green and red. Green denotes a bullish crossover, red denotes a bearish crossover. I did the same thing down here. I created a histogram, which just gives me an easy visual representation of when the two cross. So these are your bullish and bearish, or golden and death crosses. Death being a bearish crossover, golden being a bullish crossover. And now, like I said, it's not perfect. There isn't a trend indicator out there that is perfect. I've marked a few X's, which were very brief whipsaw signals right here. There's only a few of them. But for the most part, you can see that this trend indicator, although you do have these occasional whipsaw signals, when you have these two lines close together like this, or the histogram briefly crosses, there are some whipsaws. But here's what I'm getting at. This has captured the majority, almost all, and the bulk of the bigger trends in the market in recent years. Both the previous bear market, as you can see, it kept you short a lot longer than it kept you long. And that long was a counter trend rally. You may have made some money on that. And it got you long back not far off the lows. Right here, there's a dotted line, the bullish crossover. So again, pause the video and take a look at it. But you can see here, this was the first death cross on the S&P 500, the one that we had recently, since October of 2016. That's the last time, and that proved to be a little fleeting whipsaw signal. But you can see the trend was bearish. And now we're pretty deeply into bearish territory in that trend indicator. Either way, you can see down below, green just shows you this is the S&P 500 below. And again, it does a good job of capturing trends. It does have periods where there are whipsaw signals. And like any other trend indicator, I use this in conjunction with other things such as trend line breaks, divergences, everything else. So therefore, what I'm trying to get at here, if you traded this alone, you would have probably outperformed the market. You can take a look and measure it on your own charts. But if you would scrub out those whipsaw signals with the other technicals, for example, if the S&P was still above trend or you didn't have any type of sell signals, other things kept you long at that time, you would have ignored a lot of these bearish signals. So the point I'm trying to make is this death cross comes on the heels of those major breakdowns that we had, the trend line breaks in the S&P 500, QQQ, everything else, the big divergent highs that we had in the market, extreme oversold readings, and some other things that say this one is likely to stick and is most likely not just a temporary signal. Now we're going to have a kickback rally here soon. I'll get to the intermediate intraday charts here in a second. First, we'll look at the daily charts. This is the S&P 500 daily chart here. Let me move that line, move this over. The SPY. So you can see I should add another line here. You had some reactions. We briefly broke below the 20 the January. This is the February lows. I'm sorry, the correction from January to February. There, I paused the video, turn the colors up a little. You can see the candles better. So there it is. So this is a pretty key level that we were at today, and we've given that level up now. Big red impulsive candle. This is one of the biggest drops that we've had in years now. And again, this is all part of the short vol trade being busted, as I talked about. Short volatility worked for years. Institutions were able to, short volatility, profit from that, and in addition, load up on longs. There was very little risk into the market, and now risk has reappeared in the market for the first time in a while. So the institutions as well as individual investors are scrambling to protect themselves and reposition, take some of that risk or equity exposure off the table. And what you get is, unfortunately, a rush for the exits. When everyone tries to do the same thing at once, you just have an overwhelming amount of sellers compared to the willing buyers that want to step in at this point. So let's see what happens today. There's still support there around 257.90. If not, this is my next target. This level is 248.27. Here, I'll make that a little brighter for you to see. 248.27. There's some support there. 240.32. And then, before all said and done, I can see us work our way down. In fact, sometime in 2018, I still think we get down here to about that 220 level. But let's look at the 60-minute charts for a second here. Here's what we have is potential divergence. You guys hear me use this term all the time. In my book, at least, divergence is only confirmed when you have a price is making a lower low with the indicators making a higher low. And when I look at the indicators, I like to see the PPO since you have a signal line, unlike the RSI. I want to see that lower low confirmed with a bullish crossover. Right now, we don't have that. All we have is the indicators pointing lower. What does that mean? Well, they can continue lower, as can price. And if they do, they take out, we no longer have positive divergence or potential divergence, as I like to call it on the 60-minute chart. As of now, we do. So if they can ramp this market into the close today or tomorrow, there's still plenty of room. I can lower this line down here a little bit, keep this divergence intact until this line crosses below that point. So look out for a reversal. We're pretty oversold in the near term, but however, we're not that oversold on the daily charts. The SPY is a little bit, we tagged oversold here, our second oversold reading, but we don't have any bullish divergence on the daily chart on the SPY. And when I look at QQQ, we haven't even yet hit the oversold level, which is 30, that blue line down at the bottom. Last time we were oversold on the SPY, or QQQ, I'm sorry, was back here all the way in November of 2016, and we were oversold during this correction back in late June 2016. Those were good buying ops. We came close, but we didn't even hit. After that big correction off January highs into February lows, we fell shy of the 30 level, and we did again. So all I'm trying to say is there's more downside, but we're getting stretched. I wouldn't be shorting here, adding a lot of shorts if you're not already short. We have quite a few short trades on the site, but as we're hitting targets, we're closing some of those trades out. We still have longer swing trades on others. But these divergences, you have to be careful because if and when this market reverses, we're getting pretty oversold here on these intraday time frames. That could lead to a quick snapback rally. If you want to know where to, anywhere, I have a lot of lines. They're all former support resistance levels. I didn't have time to clean this chart up for the video, but we're probably up here to that 160, 166 level at least if these divergences begin to play out. I also had a level earlier I shared in the trading room on the site. right about here, and that's about 159 and change, somewhere like that. Maybe we bounce there. But again, we need to see this turn back up, this PPO, and the only way that's going to happen is if prices turn back up. And with now an hour and 45 minutes to go, um, we're either going to get that ramp into the close if the buyers step in, or you're going to see probably, could see additional selling into the close. We could have one of those 4 plus, maybe even 5% down days. I just can't tell you right now, but I can tell you these divergences are there, and they're warning that we may pop. QQQ, same story. Potential divergences here on the 60-minute time frame, but unconfirmed. PPO is still making a lower low. And also let's keep in mind that we are in bearish territory. This 9 EMA does a good job of defining trends. And when it crosses down below the zero line, that dotted line, like it did back here, it tells you the trend is bearish. And when it crosses back above, it tells you the trend is bullish. This was, quick signal, quick sell signal, and then went back long again. But right now, the overall trend is bearish. And what that also means is when the overall trend, or at least the near-term trend, is bearish, it has another meaning to me. And what that says is bullish chart patterns tend to have a higher failure rate during downtrends than they do during uptrends. Just like during a strong uptrend, bearish chart patterns either don't break down, don't play out, and if they do break down, they often prove to be whipsaw, false sell signals. So keep that in mind as well. Um, I hate to give you a lot of warnings. And that's the thing. If you don't know what to do and you're not confident of a move, don't trade it. Don't force it. Wait for the market to come to you. Wait for the cues. Let's look at this daily chart here. Here's some good support coming up here at 159.93-ish. You can see we overshot it a little on the January sell-off, but there were a lot of reactions there. And if that doesn't hold, I haven't updated. This is one board. I probably have a cleaner board for QQQ. This is where I see us going max downside before any meaningful bounce. And so this is about another 5% down. And if we get there and the charts confirm, I think that'll be a great long entry. So again, you can short here, but you could get caught in a quick snapback rally. You can trail a stop, but as I mentioned to somebody in the trading room today who's trading the VIX via certain ETNs, trailing stops work great, except when the market gaps against you. When volatility is high like this, the odds for a gap of 1 to even 2% or more are substantially increased. So what I mean by that, let's say you were to short the Qs now to ride it down another 5%, you put a 1% trailing stop or a 2% trailing stop. Well, that can work great for you, minimize your losses. If it starts to play out and you get halfway there and it reverses, you'll be stopped out for about a break even, maybe a little bit of profit. However, if tomorrow morning some headline event comes out and it causes stocks to gap up 2% or more, that's going to bypass your stop. So there's no easy way in trading, but stops are a must. They are important, whether you trail a stop or place a hard stop or manually lower or raise your stops. Don't let your losses get out of control. Sorry, I had to adjust those lines there. Sorry for the pause. That's the 15-minute chart of QQQ. I had to adjust the fibs a little bit and posted one earlier. So we still have this, again, potential divergent low. If we can get some upside here, these lines will cross. That'll confirm the divergence. That is not a 100% guaranteed buy signal, but it does help the cause or the case for a rally up. And there's also this downtrend line. So again, that would be a bounce target uh, where you might want to, quick traders can jump in, game a bounce, sell there for an expected pullback. There's some shallower targets here along the way if you want to do that as well. So that's it. As of now, like I said, these divergences are giving me a little pause, and the fact we're down so much today, it's the market can certainly drop more than 3.29%, which we're down right now. We're a little off today's lows, but with all that's going on, I don't see much more downside than this today. In fact, I think we may have put in the lows. So this is my guess. A little bit of rally here in the last part of the day, possibly rally all the way up into the close today as well. And if we don't, like I said, At most, I'm seeing about 5% downside on the markets before a meaningful bounce, and that's when we'll look to, maybe close out some more of our shorts that we have on the site and add some more longs, either new longs or add to the current longs that we have. All right, we'll wrap it up there. This has been Randy Finney with Right Side of the Chart. Best of luck with your trades.